Hi, everyone. I welcome you to the discussion on this topic, which is consolidated financial statements represented by Ind AS 110. Friends, we have already dealt with Ind AS 103, right, where we talked about that there is an acquirer and then there is an acquisition date. And then we talked about identified assets and liabilities. And then we, of course, refer to the word goodwill there, right? And that includes, of course, capital reserve. And finally, we also tried to, talk about a term called as a non-controlling interest or NCI. Okay. Now that was all about, the definition of business and then acquirer and all these stepwise details being discussed. Now, importantly, what we would like to spend time talking about, and that's what Ind AS 110 expects us to address, right? What we want to understand and discuss is that why do we need to get into all these conversations? Why do we need to understand who's the acquirer, what is the acquisition date, identifiable assets, etc.? What is that we are going to achieve out of that? Okay. Now, what I would like you to do is take into consideration some aspect like a parent and a subsidiary. All right. I'm pretty sure we have heard these terms in the past, even at our BCom level, if we have done that, or our CA intermediate level, we have talked about some group transactions per se, right? So let's try to understand the entire relationship between the business combinations accounting standard and now looking at the word consolidation. Okay. If I say that there is a company, let's say there is a company called as company X. Okay. It has some goods. Let's say, for the sake of argument, worth 100 crores of rupees. All right. Now, it is not able to sell these goods in the market because there is no active market for those products. Okay. Maybe the demand has fallen down, or maybe they're not able to get the right price, or it's going to take some longer time for them to, let's say, sell it to the intended user. Okay. But this company is for example, it's a large listed company. Okay. And we all appreciate that if it's a listed company, then there are a lot of people who are looking at the performance of that large company, right? Analysts, shareholders, bankers, government, employees, and lots such people. Okay. So whether we like it or not, such organizations are usually under a pressure to showcase a good performance. Okay. Now, if this inventory worth 100 crore rupees is lying with that company and it cannot sell that inventory, naturally that impacts the performance of the company. Okay. So what it does, because there's no prospective buyer available, what it does smartly, it goes to its subsidiary, let's name it company Y. Okay. And it tells company Y, look, you buy these goods from me. Okay. Can it do that? That's the first question. Well, of course, it's a parent company. It has that authority over the subsidiary company. After all, that subsidiary is a part of this company itself. Okay. Right. We start using the word, the parent controls the business of the subsidiary. Okay. Remember in Ind AS 103 business combinations, we were skipping that term control, right? We said that is all governed under Ind AS 110. And that is what we want to do. That's what we want to understand here. Okay. So again, coming back on this part, that company X, which directs the operations of company Y, tells company Y that, look, you need to buy these goods from me. Well, the company Y doesn't have a choice but to probably buy these goods. Okay. Now, if that transaction takes place, okay, what happens now? The company X, let's say it sells those goods for 150 crores, and that inventory becomes a cost of goods sold of 100 crores, and there comes a profit of 50 crores in the books of company X. Right? It's a very straightforward transaction. There's nothing wrong in this accounting, right? You had some goods, you sold those, so there's a cost recognized, you sold them, so there's obviously a sale is also recognized, and the difference between the two becomes your profit. Okay. And now, since company Y has purchased those goods, that now stands in the books of the company Y as inventory worth 150 crores. Right? So what has happened now? Company X is able to show a sale of 150 and also recognize a profit of 50 crores, wherein it passes on that inventory onto the subsidiary in the books of the subsidiary at 150 crore rupees. Okay. Is that permitted, first of all? Well, the answer is yes, because accounting is not prohibiting these transactions to take place, right? At the max, you would do a disclosure under related party transactions. You can very well disclose that. You are rather required to disclose this transaction. But from a standalone perspective, this is very much a sale as well as a profit, which can be recognized by company X, right? But then if we take a step back, we start asking ourselves, isn't this company Y indeed a part of the same group as company X is? Well, they are both the same in essence, in substance, they are the same entity, right? As a group, they are a single business, because of the fact that if I say that there are shareholders of company X, okay, who had put their money into company X, right? Company X, in a way, is a shareholder of company Y, which simply suggests that the money of those shareholders of company X is further invested in the shares of company Y. Okay? Which means, by the way, that these companies X and Y, for these shareholders, they are indifferent. Okay? They would like to see, these shareholders would like to see both company X and company Y as a single entity, right? Because end of the day, it's their company, right? These both companies, X and Y, are the companies of the shareholder itself. It's the shareholder's money, which is invested in company X, which eventually is also invested in company Y. Okay. So effectively, what are we trying to build here is that in the standalone books of X, yes, there could be a sale or a profit. In the standalone books of company Y, yes, the inventory could be worth 150 crores. But when these companies are brought together, when these companies are consolidated, okay, when these companies are consolidated, both company X and company Y would need to present their financial statement as if these are a single entity. Okay. And when they do so, what happens? Well, these are the two same companies, which means that one company cannot sell to itself, which means at a consolidated level, this sale of 150 crores cannot be shown, and that will be eliminated. Okay. Likewise, if you can't sell, it also means there is no purchase. At a consolidated level, even the purchase is eliminated. Okay. And if you can't sell or can't purchase, then you, of course, cannot have a profit either. Right? Can you sell to yourself and make a profit? Well, of course, it's not possible. Accounting does not allow that to happen. Otherwise, everybody would start selling to itself. Right? So when you have become a single entity, okay, when you become a single entity, you cannot sell to yourself or do a transaction with yourself, and all such intra-group transactions will get eliminated. Okay, all such intra-group transactions will get eliminated, and that is where the word consolidation comes into the picture. Okay, the very reason of preparing consolidated financial statements is that all these intra-group transactions which were otherwise inflating the numbers of those entities. Okay, I mean, you're showing a sale of 150, you're showing a cost of goods sold of 100, you're showing a profit of 50, you're also showing an inventory of 150. In reality, the true value of the inventory is only 100 crores. Okay, so when you look at this entire scenario, what are we trying to say here is that by doing consolidation, or when we do consolidation, all such transactions would get eliminated, and the right picture of the business is reflected when we do that. Okay, right? The right picture of the business as a whole, business as if these entities were a single business or a single entity. Okay, they are two separate legal entities. There's no denial about that. There's no problem with that. But when you bring them together, right, they appear to be a single entity. And that's how you start looking at the word consolidation. And that is where we need to perform something called as consolidation adjustments. Right? Ind AS 110 is all about performing those consolidation adjustments, right? That's where accounting plays the role. And that is where this becomes a very, very important standard from your examination standpoint as well. Okay, that's how you start building it across. That's how you start creating the thought process around why consolidation. Okay, and importantly, we say the term acquirer, which was there under Ind AS 103. Okay, we talked about business combinations. We talked about acquisition of a business. We talked about those inputs and processes, right? The moment I say the word acquirer, he who is the acquirer, the company that is the acquirer, is indeed the parent. Okay, and the acquirer, which is the parent, will consolidate. Okay, and that is where the business combination accounting standard and consolidated financial statements accounting standard talk to each other. Okay, he who is the acquirer shall be the parent, and the parent will consolidate. Okay. And that's what we want to talk about in terms of looking at how does this entire framework, take place under the Ind AS 110 standards perspective. Okay. What you want to remember here is, of course, the slides will be all talking about this aspect. The parent is an entity which controls the subsidiary, right? It's a definition within Ind AS 110. It says that parent is an entity that controls the subsidiary, right? Interesting definition. A subsidiary is an entity that is controlled by the parent. Okay, that's how you look at these definitions. Parent is an entity that controls the subsidiary, and subsidiary is an entity which is controlled by the parent. So how do we read it now? The entire nexus lies in the word control. Okay, the term that we had been avoiding, or we had not been talking about throughout Ind AS 110, while that reference was present. Okay, so we're saying that acquirer is the entity that is the parent, and the parent is the one which controls the subsidiary, right? Our focus will be to understand what is meant by control, because if you control, you consolidate. Okay, so the one thing that you want to remember, the entity that controls is the entity that consolidates. The entity that controls the business of the other company is the parent company, and because it controls, by virtue of the control, it will consolidate the business of the other company. All right, that is how you start looking at this entire nexus coming in. Acquisition of a business suggests control of the business, and that's where a parent and a subsidiary relationship is formed. All right, what is meant by control is something that we want to again defer for some time, but we can assume, even for examination purposes, that if one entity has more than 50% shareholding in another entity, right? When you have a majority stake in another business, right? We say the control is assumed. Okay, you don't need to have 100% stake in the other business. Very important, right? That's the reason why the word non-controlling interest is also arising in here. Okay, we are also saying, by the way, even with less than 50%, you can have control, and we'll be discussing those scenarios in terms of when can it happen, right? But what you want to pick up at this point in time, when we look at the introduction to this topic, that if an entity has more than 50% voting rights or shareholding in another entity, we assume that control exists. Okay, in your examination, you will be seeing a lot many times a term called as controlling stake. Okay, they may say there is a 70% controlling stake that X has got over Y. It means X is the parent entity because it controls. And because it controls, it will consolidate Y. All right. So that is something that you want to pick up here as a part of this particular conversation. Now, one more step that is important to address here is that if there is a company X preparing its balance sheet, statement of profit or loss, statement of cash flows, statement of changes in equity, and of course, disclosures. And there is another entity, which is company Y, also preparing its own balance sheet and statement of profit or loss, just the same set of financial statements, statement of cash flows, statement of changes in equity, and disclosures. What is consolidation all about? Right. We are now saying that there is also a set of group financial statements or consolidated financial statements where you now talk about consolidated balance sheet, consolidated statement of profit or loss, consolidated statement of cash flows, consolidated statement of changes in equity, and of course, group related disclosures. Okay. So what we want to say here is that if this were the parent company and this were the subsidiary company, okay, so company X, when it prepares its own set of financial statements, that is referred to as separate financial statements. Okay, something which is covered under Ind AS 27. Okay, when company Y prepare its own set of financial statements, even as a subsidiary, it is again resulting into separate financial statements covered through Ind AS 27. But now, X being the parent company, right? X being the parent company is also required to prepare the group financial statements. Y is not required to do that. Y is any which ways, happily doing its own set of financial statements. But X, the moment there is a parent company, the moment somebody, for example, has a control, although there are a bigger framework when we look at, that perspective of the scoping requirement. But broadly, if I say there is a parent company, for example, then they do not only prepare separate financial statements, but they would also prepare consolidated financial statements. Okay, so we are saying, of course, the group financial statements which are required to be prepared by that parent company. Okay, that's how this entire structuring is going. You bring the business combination, the word acquirer would mean the parent, and accordingly the all the set of, let's say, transactions and consolidation, for example, would start taking place. Why are we doing consolidation? Because if you don't do the consolidation, if you don't cancel out those group transactions, right, that would start ballooning the numbers, it would start inflating the numbers. You start showing higher sales and higher purchases or expenses or investments or profitability, etc. They are all required to be eliminated. Okay, they're all required to be eliminated, and you present a clean picture of the group in terms of what has been the performance and the position of the group as a whole, as a single entity, right? How have X and Y together performed? And that is where the transactions between X and Y would get eliminated there. Okay. So that is something which is the broader perspective that we wanted to bring along when you look at introduction to Ind AS 110, which is consolidated financial statements. What we're going to talk about here is in detail. For example, what are the scope requirements, what are the exemptions or exceptions to this Ind AS 110? For example, are we always required to consolidate? Can there be some exceptions and the reasons thereof, right? We start looking at, of course, very, very importantly, what is the word control there, right? When do you prepare the consolidated financial statements? For whom you prepare the consolidation financial statements? Within the gamut of group, there is also a reference of something called as investment entities. There are peculiar requirements under this framework of what is the accounting for investment entities. That's what we also want to discuss. What is the consolidation procedure? Very, very critical. This is purely examination focused, right? That's what you need to be very, very comfortable knowing, right? A lot of questions that we intend to do as a part of the discussions. And finally, how to analyze various situations while accounting for and preparing those consolidated financial statements is something that we want to cover. And also then we look at something called as, what if, let's say there is a company X, let's say that controls company Y. But interestingly, there is also a company Z, which is controlled by company Y. So in a way, there is a chain being formed. Okay. So there are, again, these kind of complex scenarios also which are present. Then how do you look at, bringing accounting in that framework is something that we want to discuss as a part of this standard throughout. All right. Thank you very much.